Hi, my name is Eric Hagan. I am president of Capital Consulting Group. We do a lot of things differently than the average financial advisor, and today we're going to look at one of them. For many of our clients, when the market is trending up, they are invested. But when the trend changes and the market enters a downtrend, instead of remaining invested as it continues down, we go into our clients' accounts, sell their investments, get out of the market, take a breather, if you will, and wait on the sidelines until the markets return to an uptrend again, at which time we then go and reinvest for them. The goal of this video is to provide some more detail into how the uptrends and the downtrends of the markets are identified. But before I explain the how, I want to take a minute to explain the why. Why do we even do all this extra work? And it has to do with the difference between being in the right place at the right time versus avoiding being in the wrong place at the wrong time. Think about trying to win the lottery. Is winning the lottery an easy thing to do? No, it's very hard, right? Now think about trying to avoid getting struck by lightning. If you're outside and you see a storm coming, you can just go inside, right? Avoiding getting struck by lightning is a much easier thing to do than winning the lottery. You see, being in the right place at the right time is a very difficult thing to do. Avoiding being in the wrong place at the wrong time isn't as hard. And the same thing can be said about investing. Picking the next Google or Amazon or Netflix stock today would be very, very difficult. Here's an illustration. Let's say that you were able to put $200 in the market, the S&P 500 for instance, way back in 1928, and you left that money alone through the end of 2016. Well, in 2016, you'd have $23,734 in your account. However, if you had invested the same $200 in 1928 and you missed just the 30 best months during those 86 years, you wouldn't have $23,734. You'd instead have just $898. Now let's say that you had taken the same $200 from 1928 to 2016. You didn't buy and hold. You didn't miss the best 30 months, but instead you missed just the 30 worst months, meaning you missed being in the wrong place at the wrong time. Well, you wouldn't have $23,000. You wouldn't have $898. Instead, your account would be valued at more than $1,896,000. Now, the point of this is not to suggest that it's possible to avoid those 30 worst months over time. The point is to answer the question, is it even worth trying? And I think the numbers speak for themselves. So this is the why. This is the why we even think trying is worth it. Now let's look at the how. And there are a lot of different ways. In this lesson, I'm going to explain one such method that we use with many of our clients. In this case, we use something called exponential moving averages. Here's how it works. The first thing that happens is to determine the daily price of your investments. What are they worth? You can apply it to just about any investment, like stocks or ETFs or mutual funds. We usually invest in individual stocks for our clients, so we might use the average price of all the stocks in our clients' accounts. Whatever you do, the point is to track the daily price movement or the daily value of those investments that you own. So again, this is done every day. When it moves up, we mark it green. When it moves down, red. Then this average price is mapped out on a chart which allows us to see the long-term average price and the short-term average price. When the short-term average price crosses down over the long-term average price, while absolutely not guaranteed, this is used as an indication that a bigger slide or a bigger decline may be ahead. So you would sell that investment to protect from further losses. Remember, we want to avoid being in the wrong place at the wrong time. Now when the short-term average price then crosses back over the long-term average price, well, this crossover is used as an indication that the decline is over and the trend is back upward again. So you would reinvest at this point to participate in any gains. Ultimately, having a strategy not only for getting out of the market, but also sometimes more importantly, for getting back in. Here's a way that you can do it on your own. Go to a website like stockcharts.com. Here you can track just about any stock, mutual fund, or ETF. I'm going to plug in SPY. This is an ETF that tracks the S&P 500. Then further down on this page, look for the section that says Overlays. You're going to change the drop down so they look like this. What you want to do is compare two different time frames, a shorter time frame versus a longer time frame. Here I'm going to use 30 days and compare it against a 60-day exponential moving average. You can play with this as you like. When you're ready, click on Update. You should get a chart that looks like this. You'll see that the blue line, the shorter term average, is over the red line. It's above it, the longer term average. This tells us that as of this recording here in mid-August 2018, the market is in an uptrend. When the blue line crosses down over the red line, well, that would be an indication that the uptrend has ended and that further decline could be expected. Instead of riding that decline lower, you could use this indicator to sell investments that you hold and wait for the next uptrend. So does it work? Well, the first thing that you should know is that using the crossovers does not mean that you cannot lose money. The goal with using the crossovers is to identify the larger trends in the market. Here is how one index that we use, called the Power Dividend Index, performed from 2000 through 2017. It uses exponential moving averages, and it moved out of the market just 5 times over these 17 years. And it grew $100,000 to over $920,000 during that period of 2000 through 2017. Remember, this was during a time when the overall markets fell in half not once, but twice. Here's the Power Momentum Index. It grew $100,000 to more than $642,000 during that same time period when the overall markets fell in half not once, but twice. Here's a Mid-Cap Index, the Power Dividend Mid-Cap Index. It grew $100,000 to over $1.1 million. Here's an international index called the Power Dividend International Index. It grew $100,000 to over $682,000. Here's a bond index, not even in the stock market, called the Power Treasury Total Return Index. Over the past 10 years, it more than doubled $100,000 to over $237,000, and all it invests in is U.S. Treasuries. Here we have another bond index, the Power Floating Rate Index. Again, investing in just bonds, it grew $100,000 to more than $312,000. Picking good investments is important, but here at Capital Consulting Group, we believe that avoiding being in the wrong place at the wrong time is even more important. If you have questions about incorporating exponential moving averages into your unique situation, please reach out to me or my team. We can work with your IRA, your Roth IRA, maybe an old 401k that you have sitting out there, or even your taxable account, and even trusts that you may own. And because we focus on investing in individual stocks, we often eliminate the many expenses that come with investing in mutual funds, annuities, or even ETFs. At Capital Consulting Group, we consider it a privilege to serve. Thank you again for this opportunity to do just that.